Yes, your boy Crypto Blood, and welcome to another My 2 Cents. This morning we are looking at, you won't believe it, they're already talking about QE5. Haven't even started, not QE4, right? That's what we're supposed to believe. But there's an article out of Zero Hedge that kind of talks about that. But we're going to also look at something, and you know, normally I don't like to look at CNBC, or mainstream financial media outlets. They normally try to stick to the narrative and paint a certain picture, but even they have to admit it looks like, you know, the Fed is in this repo game. They're going to be here for a minute. They're calling it, CNBC's calling it standing repo operation. We call it POMO, permanent open market operation. Same thing, just semantics in my opinion. You know, we're getting down to semantics with this, but we're going to take a look at that. Also look at when the Fed thinks the next repo crisis will strike. All this in a second, but first, make sure you hit that thumbs up. All you losers, hit that thumbs down. Subscribe to the channel, people. Let's get this thing cracking. So since we got all that out the way, let's first take a look at what the Dow Jones did yesterday. Down 0.4%. Still near highs. Look at that, near all-time highs. We zoom out to the 1-year chart, and we're not going anywhere but up, in my opinion, because they're going to try every and anything. They're going to throw it all at the wall to keep this thing going, at least through the election time. And to be honest with you, I think that's a stretch. I don't even know how they're going to make this thing last till next November. I really do not know, but they're going to try. They're definitely going to try. So higher prices on the indices are in the making here. And then gold not doing any better, really, down 0.23%, almost 0.25%. Same thing with gold, same narrative I've been saying. Gold is not going to perform this time, guys. We're in a different environment, so don't get suckered into that whole gold, silver theme that has really lost you a lot of money. That trade has lost you a lot of money. I mean, you would have made some money maybe if you bought back here in August of 2018. If you would have bought the dips, you could have possibly made some money. But most people really, to be honest with you, probably bought gold 1,200, 1,300, 1,400, where we are right now. Even if you did buy it in, you know, at 1,000 or a little bit lower, you know, over 10 years, I mean, you would have made more money being in equities. And at the end of the day, most people are looking to make some profit from this gold trade. Some will say they're not. It's the price of gold versus the gold price. I've heard all that. But at the end of the day, I don't think gold will be the asset that's going to outperform in this type of environment. I personally think something like Bitcoin will do much better in an environment like this. Even though there's no correlation, I'm just saying when stuff hits the fan, I think you're going to definitely see Bitcoin take out that high of 20,000. I'm a millennial, so I'm going to say, you know, I'm buying Bitcoin and cryptocurrencies as a hedge. Best play I've ever made in my life today. So we'll see how that pans out in the next year or two. But let's go ahead and take a look at this Fed article out of CNBC. And the headline says the Fed is looking at a standing repo operation to handle overnight funding issues. Some key points here. It says that in their October 29th and 30th meeting, FOMC members weighted several options ahead for keeping the repo market stable and maintaining the central bank's key lending rate within target range. Why are they doing this? If nothing is wrong, if the economy is strong, why are they looking to do this? What are they looking to maintain? The discussions came about a month and a half after funding pressure sent repo rates soaring and the Fed funds rate briefly above its target range. So it said the Federal Reserve officials are continuing to look at ways to make sure funding pressures in the overnight lending market don't cause a problem again. At their October 29th and 30th meeting, the FOMC members weighed several options ahead for keeping the repo market stable and maintaining the central bank's key lending rate within its target range. One option that received considerable discussion was the so-called standing repo facility, essentially a mechanism where the Fed will step in whenever needed to supply banks with reserves in exchange for ultra-safe collateral like Treasury debt. A standing repo would likely provide substantial assurance of control over the federal funds rate, but use of the facility could become stigmatized, particularly if the rate was set at a relatively high level. And so in addition to that, Their notes also said, we've heard this before, modestly sized, relatively frequent repo operations that nonetheless would not be permanent. Where have we heard that before? Of course it's going to be permanent. We've really never stopped QE. You call it QE 1, 2, 3, Operation Twist. They say they stopped and started buying back and some of the bonds and the debt that they issued out, but come on now. That only lasted so long before they had to ramp up and do it again. And I'm not even convinced that they even stopped Operation Twist, to be honest with you. I'm sure they could have done some type of backdoor way to keep this funding for a lot of these banks, maybe outside of the U.S. borders. There's been some debate about how to see the operations the Fed has instituted to handle the repo issues, which were attributed to a high degree of Treasury auction settlements and corporate tax payments that drain liquidity from the system. But this is a point that we need to really look at, and this is why we're near all-time highs. The market is looking at this as some type of QE4 operation. You won't believe this. Their balance sheet has expanded 7.4% since the repo issues to near $4.1 trillion. Wow. And from this article from Zero Hedge, what I really want to point out in this one, as far as the Fed revealing the next repo crisis and when it may strike, well, they're looking to essentially continue this Treasury bill purchase program into the second quarter of 2020 and to continue conducting overnight and term repo operations at least through January of next year. What are they not telling us, people? What are they not telling us? We know that the pace of purchase is around 60 billion, and together with the Fed's various repo operations, the Fed's balance sheet has increased by 285 billion in the past 8 weeks. I'm going to say that again. 285 billion in the past 8 weeks. Listen to this. The fastest expansion on record. This is surpassing QE 1, 2, and 3. And just remember, this is not QE4. Look at that balance sheet. Look at that balance sheet. Insane, man. Something is at critical levels right now. We got cold blue right now on the markets. It stopped breathing. The markets have stopped breathing, and the Fed is in there trying to administer CPR. And so in these notes, in this meeting, the notes also talk about them actually thinking about monetizing coupons as well, not just T-bills. And so T-bills are essentially what's being worked with in the repo markets, guys. Those are bills or bonds that are like 4 to 13, even 26 weeks, versus if we're talking about your traditional Treasury notes, which we know are kind of what you think of as T-bonds. Those mature more on the 3, 5, 6, 10 year. That's what we normally hear about. But the T-bills are kind of really short term, in what the repo guys in the repo market really uses a lot. And there are some additional differences, but we're not going to get into the technicals. But I just want to kind of point that out. So they're looking at possibly going past the T-bills, which is what they're dealing with right now, and heading into essentially what QE 1, 2, and 3 were, which was the monetization of your 2-year, 3-year, 4-year, 5, all those 5-year, 10-year notes. So this is basically going to head. This is literally turning to full out QE4 with like no joking around, like seriously. And really, one of the primary reasons they want to keep this whole standing, quote unquote, standing repo operations going into next year, second quarter, is because typically around tax season, there are some additional strains in that market because rebates are starting to go out from taxes and stuff. That kind of correlates with that, and there's typically some strain there at that point. So I'm sure they're going to be there to help in that time as well. So it's just getting out of control. It's never going to stop, people. Never going to stop. Is one thing I have to agree with Peter Schiff on. He's right about one thing. He's lost his clients all that money talking about Bitcoin is trash. But one thing he's right about is that QE never stopped. The last article I just want to touch on really quickly out of Zero Hedge as well, it's about this QE5. It's also priced in. They're saying they think QE5 is priced in. What is QE5? What does that even look like? I wanted to look at this article with you guys. The S&P 500 will be up more than 30% year to year by Christmas, assuming unchanged S&P levels from here. That's crazy. Such yearly increases have usually gone hand in hand with much bigger liquidity increases that we are seeing right now. There is clearly a FOMO in markets on the asset pricing positivity stemming from the soft QE from the Fed that we just talked about. And these charts, at least this one here, showing the S&P correlation with the yearly change in excess liquidity. That red line there is essentially showing where we are right now in the markets. If nothing changes, this is what it would look like by December 31st. If it stays unchanged. But we know it wants to pull back. The markets want to pull back, so it will probably test the Fed between now and the end of the year. The markets will test the Feds, and at that point we'll probably see what I talked about in the past article regarding starting to buy T-bonds, not just T-bills, the longer end of the yield curve. That's when QE5 will be on and popping. Because QE4 is essentially us just buying these T-bills. That's what they're kind of labeling QE5. That is us going into those T-bonds and monetizing those. And it's most likely going to happen. I'm telling you, the market is going to test the Feds. And at that point, the Fed has no choice but to begin QE5. Because we're in QE4 right now. You can believe it or not, we are definitely in QE4 right now as we speak. Let me know your thoughts about this whole situation. Do you think the Fed can keep this thing going into November? That's the big question. Like, I don't think so, but I know they're going to try to. And, don't fight the Fed. That's the saying on Wall Street. And if that's the case, we may be sitting at Dow 40,000 by election night 2020. Let me know your thoughts. Make sure, again, to like, share, and subscribe. And if you want to hear anything more on the crypto side of things, you'll get a video later today around 6 p.m. Eastern Standard Time. That's my 2 Satoshis. It's your boy Crypto Blood, and I'm out of here. Holla!